What's up, guys? Chris Rivera here, aka the Ecommerce Accountant, aka your favorite balding CPA. So in this video today, we're going to cover tax savings opportunities by structuring your business through Puerto Rico, and I have a ton of content here that is going to be extremely valuable to you and your e-com business. So the topics that we're going to cover is number one, how Americans are taxed, because it's very important in understanding why Puerto Rico is such a great tax haven for you to structure your business through. Number two, we're going to crunch through the numbers and understand why exactly you're saving money through structuring your business in Puerto Rico. Number three, we're going to talk through the rules that you need to follow. Very, very important. They're pretty strict in terms of, obviously, it makes sense. If you're going to save, 20 to 30% tax rate, percent on your taxes, obviously the rules are going to be very strict, but they're not super complex to follow if you're an e-com business owner. And then lastly, we're going to walk through an example of how this could look for you. So really quickly, before we hop into the details, fun fact about me, I'm actually 100% Puerto Rican. All four of my grandparents came from Puerto Rico, and I'm what they call a Nuyorican, which means I was born and raised in New York, even though I'm full Puerto Rican. BX, holla. All jokes aside, I've been to Puerto Rico before. I love the culture there. The food is fantastic. But my personal favorite thing about it is the weather is amazing. It's a tropical climate. So even if you're the type of person that's worried about moving away from home just because you're saving money on taxes, boo-hoo. You're going to have fun in the sun. And you're going to see here in the underlying rules that you don't have to live in Puerto Rico all the time to qualify for these great tax benefits. So without further ado, let's hop into my computer and dig into the details. Okay, so jumping into the itinerary here, topic one, how are Americans taxed? This is very important to understand why the Puerto Rico tax planning strategy is so beneficial. So let's take Joe Schmo here. Joe Schmo lives in New York City. He owns Dropshipper LLC. Obviously, you understand that Joe Schmo, as an American citizen, is going to have to pay U.S. income taxes. It's tax time, bruh. But in all seriousness, obviously as a citizen and living in the U.S., Joe Schmo has to pay U.S. income taxes. Check this out, another scenario here. Joe Schmo now lives in Paris. He's lived in Paris the entire year. He runs his business entity from Paris. Dropshipper LLC, let's say it's even a Parisian business entity, okay? Guess what? If Joe Schmo is a U.S. citizen, it's tax time, bruh. Seriously, even though Joe Schmo lives in another country and is generating income in another country and even is paying income taxes in another country, the IRS is still going to try and put their hand in your pocket and force you to pay income taxes to the United States. So what really stinks here is, as you can see, as a U.S. citizen, the IRS has their hand in your pocket pretty much no matter where you're located. And the number one question I get as it pertains to this conversation is, well, what if I set up a business entity or a corporation? Does that stop them? And the answer is simply no, it doesn't. As part of the new Trump rules, there's this new GILTI tax that's been rolled out. No, not that guilty. GILTI, G-I-L-T-I. Basically what it says is, even if you have a foreign corporation that generates income taxes, right, or generates income and pays income taxes in a foreign jurisdiction, you still have to pay taxes in the U.S. It's a very complex calculation. We're not going to get into it, but there's one very important exception. GILTI does not apply to... It does not apply to... It does not apply to Puerto Rico. Seriously, check this out. If Joe Schmo lives in Puerto Rico, right, and has an Act 20 corporation and does not have any operations in the U.S., like his operation is solely based in Puerto Rico, and we'll get into those rules here in just a second, he does not have to pay U.S. income taxes, even if Joe Schmo is a citizen. Unlike Paris, in that situation where he has to pay both, Paris or French taxes and U.S. income taxes, as long as Joe Schmo is a bona fide resident and has an Act 20 corporation, he does not have to pay U.S. income taxes. Only Puerto Rican income taxes, which we're going to see here in a second, are far more favorable than the IRS rules that we have here in the United States. All right, now let's hop into topic 2, number crunching. Let's dig through the numbers and figure out how specifically you're going to save money in taxes. So again, no tax planning strategy here. This is very similar to the example that we went over in my S Corp videos, but here in this example, this is under no tax planning strategy. This is if you set up an LLC and did no other specialized elections, or if you have no business entity at all and you're just operating as a sole proprietor. So again, just as a review of things you probably already know, the IRS is going to tax you twice if you're self-employed. And again, that's if you have a business entity or don't, okay? So you're gonna get hit with income taxes, you're gonna get hit with employment taxes, okay? So just note that your net profit number is the same for both your income taxes and your employment taxes. I'll skip ahead to save you the brain draining details, but basically with $100,000 in income, and again, we'll assume some tax adjustments here. I'm not going to dig into that rabbit hole, but basically you have a taxable income of 85.7K. You get hit with a 24% tax rate because with $85,000, you're in the 24% tax bracket. Okay, so you end up with an income tax of 14.8, call it 14.9K. Okay, on top of that, again, the IRS double taxes you. You get hit with self-employment taxes. So we're talking about $100,000 here in business income. We'll cut through the details here to get to the 15.3% employment tax rate for being self-employed. On top of your income taxes of 14.8K, you get hit with employment taxes of 14.1K, or what you end up with is 28.9K, or call it $29,000 in total taxes, okay, between income taxes and self-employment taxes, which is a 28.9% rate. Not great on $100,000 of income. You should be tax planning, whether it's the S Corp tax planning strategy or structuring through Puerto Rico. You should be doing something to reduce this tax bill. So let's walk through Puerto Rico. Puerto Rico tax planning strategy. So you have two different types of tax here. Unlike if I go back to the last slide, in the US, you have income taxes and you have employment taxes. In Puerto Rico, it's a little bit different. You're going to have corporate income taxes because Act 20, and again, we'll go through the specifics of Act 20 shortly, but you have corporate income taxes for an Act 20 Puerto Rico corporation, and then you have individual income taxes for being a Puerto Rican resident, okay? So we'll start off with corporate income taxes. We're going to go with the same $100,000 of income, except for the fact that the owner has to pay himself a salary. And again, in Puerto Rico, it's just like the US, you have to pay yourself a reasonable salary. What we used for a reasonable salary is basically $30,000, which is 30% of your total profits, which in the US, in my professional opinion, is a reasonable salary. So it's not $100,000 of taxable income through your corporation. It's actually $70,000 because you deducted $30,000 in your owner's salary. Okay, check this out. Taxable income is $70,000. It gets hit with a 4% tax rate to get to $2,800. Okay, now I don't want to cut any corners here. On top of this, you have to pay individual income taxes because look, you paid yourself a salary. So if we go with your salary income of $30,000, I did a little bit of research in Puerto Rico to figure out what tax adjustments would look like. I came up with $7,500. I'm sure you can find ways to crunch that number down even further. I'm not a Puerto Rico licensed accountant, but what I will say is that they do have some other ways that you can reduce your tax burden. So I just kept it simple. Let's leave it at $7,500. You get to a taxable income of 22.5K, 33% tax rate for individuals. You're looking at $7,400. In total, you're looking at 10.2K. And this is conservative. There's going to be ways that you could drive down this tax bill even further, but just to be conservative, this is more or less what you'd be looking at. As compared to, if I flip back to the no tax planning strategy in the US, you're looking at $29,000. So you're looking at almost a 20K reduction in your total taxes. Okay, next up here, topic 3, what are the rules? So, based on the rules, how do I qualify for Puerto Rico tax savings? And it really boils down to these two things here. You just need to memorize two specific sets of rules. Number one is you need to own an Act 20 Puerto Rican corporation, and number two You need to be a bona fide resident of Puerto Rico. Let's hop into the details and figure out what each of these mean. Okay, so how to qualify for an Act 20 corporation. Number one, you have to apply for Act 20 status, and it can be very expensive. I'm not gonna lie to you. I'm actually in the process of helping one of my clients transition their business from the United States to the Puerto Rico. And by the way, just a bit of a spoiler alert, we're gonna talk through a very complex planning strategy that we're implementing for them. And it's in the process of being done, not finalized, but the paperwork is being filed for the application as we speak. But it's an application process, and it's gonna cost you anywhere from $15,000 to $30,000 just to apply. So it's very easy to get approved as long as you structure the business appropriately, but make sure that you understand that it's not just like, oh, I'm gonna move to Puerto Rico and now I'm saving money. No, there's a significant investment that you have to include to apply for the Act 20 status. Not a deal breaker by any means, but just make sure you go into it with the right expectations. So next up here, you need to provide a service from Puerto Rico to people or businesses outside of Puerto Rico. So this Act 20 rule is only applicable to specific types of Puerto Rican corporations. So Puerto Rican corporations have a tax rate just like the US, and it's not 4% for all corporations. It's 4% for only Act 20 corporations. And you have to apply for Act 20. And the way they approve you is if you fit into a certain type of business, a certain category, and that's your service providing business. Now, some of you may think like, oh, I'm an e-commerce, I'm a drop shipper. There are ways to structure your business so that you are in the business of being a service provider for companies and or people outside of the US. And again, we're gonna show you the details for what we did for one of my clients for their application. And then last up here, if your company earns $3 million or more in revenues, just keep that in mind, it's a revenue number, you need to hire a full-time Puerto Rican employee. Guess what? That Puerto Rican employee can be, you guessed it, you. So just keep that in mind, not a Puerto Rican tax expert, but according to our research, you can hire yourself as a Puerto Rican employee. Because again, part of this is you have to be a bona fide resident, which means you're Puerto Rican and you'll be an employee of your corporation. Okay, so next up here, how to qualify as a bona fide resident. It's a 3-step test. Again, there's 2 steps to qualifying for Puerto Rican tax savings. Step 1 is you have to have Act 20 status for your corporation. Step 2 is you have to be a bona fide resident. There's 3 steps for how the IRS, and again, it's a little bit confusing. It's not Puerto Rico. Puerto Rico will approve you for Act 20, but the IRS makes it important for you to consider yourself a bona fide resident. Because if you're not a bona fide resident in Puerto Rico, the IRS is going to want for you to pay them taxes. And that's not what you want. You don't want to be caught in the guilty rules. Remember the guilty rules? Okay, so 3-step test to qualify as a bona fide resident. Step 1, personal presence test, aka what I refer to as the where you at test. You must spend 183 days or more in Puerto Rico. I recommend spending quite a bit more than that just in case. There can be pitfalls and rules, or maybe you get caught up and can't, you plan on spending 183 days in Puerto Rico, but something happens and you're not there for 183 days. You want to be very careful and make sure that you are substantially present in Puerto Rico. Plan for 200 days. Give yourself some buffer. So that's the personal presence test. Next up here, we have the tax home test, aka where you live at test. This is really centered around your everyday life. Where is your real tax home? And the best way to establish your tax home is centering your business around your tax home. It's something easy to point to. So what I listed here are things that are common pitfalls with e-com business owners that you want to be careful of. This can wreck your tax home status in Puerto Rico. So number 1, don't warehouse any inventory in the US. Now for those of you in Amazon FBA, or if you just warehouse inventory in the US in general, I have a workaround for that. As a matter of fact, the client that I have that's transitioning their business from US to Puerto Rico is in fact the type of business that used to be a drop shipper. Now they warehouse inventory and ship their products from the US. So there's a workaround. But be very careful how you structure this. So, no warehousing inventory in the US. No US employees. If you have US employees, including yourself, you need to be very careful because that establishes a presence in the US, and that could draw your presence into the US. No US offices. Obviously, you don't want a US office space because that leads the IRS to believe that, hey, this person has an office space and employees in the US. I don't think they're a bona fide resident. Their entire operation is in the US. You expect us to believe that his tax home, the where you live at test, is in Puerto Rico? No way. Last step here, the closer connection test, aka don't let me catch you slipping test. When I read through the detail for what the IRS laid out here, I understood very quickly that it's in true IRS fashion, a catch-all test. This is it's not super black and white. They kind of leave it loose so that this is the closer connection test. We don't think you're Puerto Rican bona fide residents. You want to be very careful. The ways that I recommend, and actually the IRS includes these examples in their guidance, is number one, keep your apartment year-round in Puerto Rico. Buy a house in Puerto Rico. Get an apartment in Puerto Rico. Keep it year-round. Do not Airbnb. If you Airbnb for a couple weeks at a time or months, that does not look like, think about the tax home test, where you live at. That does not look good to the IRS. Next up here, get a Puerto Rico driver's license. Easy enough. You live in Puerto Rico, you're driving a car in Puerto Rico, get a freaking Puerto Rican driver's license. It's a good way to prove, like, hey, I live in Puerto Rico. Check out my Puerto Rican driver's license. And last up here, register to vote in Puerto Rico. Very important. As again, it's a U.S. territory, so you can still vote in the presidential election, let's say. Just you'll be voting from Puerto Rico, and your vote will count towards the Puerto Rican Electoral College. Topic 4, structuring example. Okay, so here's where we're going to jump into the detail for an example that if you have inventory, how this would look for you. And again, Act 20 works perfectly for if you're a drop shipper or you're a digital marketer, okay? If you're drop shipping products, you have no inventory risk. Chances are you have a physical presence where you're working. Same thing for if you're a digital marketer, own a social media marketing agency, etc. It's very easy to prove that you're providing a service and you can qualify for Act 20 status. Then all you have to do is pick up that butt of yours, move it to Puerto Rico, apply for Act 20 status, and be a bona fide resident. Bingo, you're done. But the question becomes, what if you have inventory? Because a lot of e-commerce business owners warehouse inventory in the US. Even drop shippers, they find their hot product and then they mass purchase it, warehouse it in the US, and fulfill from the US to cut down on shipping times, chargebacks, refunds, keep customers happy, etc. Check out this example, and this is a real-world example for a structuring that we just did for a client of mine that has their application in for Act 20 status for Puerto Rico. And the lawyers are telling us this is going to get approved within the next couple of weeks. So check this out. We have Joe Schmo again. He owns 2 business entities. He owns a U.S. corporation, okay? U.S. corporations get taxed at 21%, okay? A little bit different than the example we walked through earlier, the no tax planning strategy. This is corporation. You have a fixed tax rate of 21% no matter what. Also, Joe Schmo owns 100% of a Puerto Rico corporation that has Act 20 status. They applied for Act 20 status, got approved, 4% tax rate. Joe Schmo lives in Puerto Rico, okay, for 183 days or more. Let's say 200 days he lives in Puerto Rico. So right off the bat, he has Act 20 status and he's a bona fide resident of Puerto Rico. So let's walk through the specifics for how this works, okay? Puerto Rico Corporation is in the business of drop shipping. Now forget for a second, under the old situation, Joe Schmo brought in a bunch of inventory in the US, warehoused it in the US, and it's not really a drop shipping model. He owns inventory and it's just a fulfillment. He markets to customers, and as the orders come in, he fulfills through his inventory. But check this out. You're breaking the business up into 2 parts. One part is this Puerto Rico corporation, which is in the business of drop shipping, okay? Stay with me here. The second corporation is a U.S. corporation. It's inventory, physical property based in the U.S., owned by Joe, okay? And that corporation is in the business of order fulfillment. okay? Anytime they're in the business of purchasing inventory from China, warehousing it, and anytime they get an order, they fulfill the order. Basically, they're the 3PL company or the supplier or the shipping agent for Joe Schmo, okay? Or this Puerto Rico corporation, okay? So the way this works is when a customer, and this is Pitchfork Pete, he's an angry customer, so he wants his product quick, so that's why Joe Schmo is warehousing in the US in the first place, okay? So customer pays $10 for an e-commerce purchase, okay? Puerto Rico Corporation recognizes those revenues. That's income to the Puerto Rico Corporation. You know, in that corporation is things like ad spend, compensation, all of the business expenses that you can think of with running an e-com business operation, including cost of goods sold. This is a drop shipping business. Anytime an order comes in to the Puerto Rico Corporation has to fulfill that order with their supplier. So let's say that your cost per unit is $2. $2 payment to fulfill e-com orders goes to the U.S. corporation. The U.S. corporation receives that order, right, and ships the product out to the customer. This is a true drop shipping operation on behalf of the Puerto Rico corporation. It's truly drop shipping. There's different entities at play here. Now, this U.S. corporation has to make money. Do some research into what's called transfer pricing, and to be honest with you, just pay an attorney to figure out what a good markup rate is. When I say markup, what I mean is this company makes money. It has to be profitable, otherwise the IRS won't allow this. So $2 comes into the U.S. corporation. Let's say each one of these units costs $1 in China, okay? That means there's 100% markup on each product, meaning this U.S. corporation bought one unit of inventory for $1, right? From China, so now they have inventory. Then when they sell, they get revenues in for $2. They have net profit of $1, right? So this company is making money. The name of the game is you want to shift most of your income to this Puerto Rico corporation because look at the tax rates. See, it's a much lower tax rate in Puerto Rico. So you want most of your revenues and profits to be in Puerto Rico where the tax rate is lower. And then for the U.S. corporation, you want to show some income, but not a lot of income. You want to show just enough so that it's fair that the IRS will leave you alone, which includes paying taxes to the IRS. You will pay U.S. income taxes under this structure, and that's pretty much it. Thanks so much for watching. I hope that you got a tremendous amount of value from that content. If you did, smash that like button, subscribe, and definitely follow me on Instagram. I'm pretty responsive to my DMs. You can find me at Ecommerce Accountant. Have a great day.